Taxes suck, there is no doubt about it, but this video is not about taxes. This is just basic general investing advice. And you've heard the term probably time in the market beats timing the market, right? Or something similar, meaning leave your money in the market forever and you're gonna be fine. And while that's not necessarily true, the moral of this video is it's absolutely true. And we're gonna just do a basic, simple example to demonstrate what that actually means. Now, we're not gonna get into any specifics. I may put up on the screen, you'll see that here shortly, an actual look at the S&P 500 over time so you can see how that has truly grown over the years. And we're just gonna use a map I make up right here to kind of simulate the lesson within that. So let's just take, it doesn't even matter what the time or what the market value is in this picture. Let's just draw a little line. We're gonna draw, here's the market going up, 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 oh, it went way down, now it's coming back up, down, little dip, up, 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 little big dip, and we're going back up, little dips in between, and we keep going. So this is simulating our returns over time. The total value in this case of the S&P 500 starts at a certain point. Over time, it's increased to a much higher point. But along the way, we have these little dips and dives, right? This line goes down, it goes down, it goes down, it goes way down, it goes up, it goes little downs, and then we just, at some point, it finds its trajectory and continues going up. So, what time in the market? What is the value of it? Let's just use one simple example here to really prove out that. Let's say you invested right here, right at the top of the market. And let's say that was 5 years in. Let's just assume let's say this is 15 right here at this point. So you got in at the 5-year mark, you bought right here, it went way down immediately. What's your thought? Why the heck did I do this? What am I doing? I don't know how to invest. I don't know even what I'm investing in. What's in the S&P 500? What's in this ETF I bought? Blah, blah, blah. Rest assured, we're gonna figure out exactly what happens here because we can probably already see the relationship we're talking about here. If you stay time in the market, depending on how far you are, you're gonna follow these graphs up here. And that amount you bought here is ultimately gonna be worth more, especially if we're talking about funds that just reflect the S&P 500 itself. We can demonstrate over time that the S&P has grown at a certain rate and it will continue to do so unless major things change that would just completely topple the picture on its head. We'd have other problems to worry about, right? But what we're gonna rely on is history here, proven history. You're in at 5 years, at 15 years, you're right here. Almost every point leading up to that, right? Everything underneath this, 5 to 10 to 12 years, it's gonna feel like you lost money, and you have, by all intents and purposes. If you were to take your money out of the stock market at that point in time, or any time before you crossed over this point here and got above that, you will have lost money. Again, time in the market. If you just waited a little bit longer from that 12-year mark to the 15-year mark, boom, what is that? That is much higher than where you bought in. You've made money, right? You made money. What's gonna happen here? You're gonna dip again. You're gonna go up, it's gonna dip. You're gonna forget that you already made a bunch of money, right? It's gonna feel terrible when the market goes down. You have that money you put in, you need it, it's in your investment, it's very important to you, and you wanna understand, holy shit, should I stay in this? Should I get out of the market again? No, stay in, because again, this graph, as I just drew it, as I just made it up as I went, roughly estimates how the S&P, how the stock market performs over the years. Because people want to invest, because there's ultimately people want to put money in and make money on the stock market, the relationship you see continues and will continue into the future. In that, people continuing to invest, the stock market continues to gain value, and what does that mean for you, Mr. Person who's invested in the stock market? Your money's going to continue gaining value as well. And all we're using to justify this is history, historical precedent. This is what has happened to the total stock market. When you look at the total stock market, in this case, the S&P 500 is what we're looking at. It has gone up over time, like without fail, without consistency. Now, or with consistency. Now, certainly we've gone through big dives, much larger than what I'm showing here, that could dip way down here. But again, if you buy here, go through a big dip here, and end up with money still over here, that same investment, it's grown. It doesn't matter. That's the point. If you get in at any point and you allow the money, you allow the stock market to work, you are going to make money. This is how millionaires are made. Regular, everyday millionaires, people who sock money into their 401k, their Roth IRA, their brokerage, whatever it may be. Leave that money there and allow it to grow over time. Once more, time in the market beats timing the market, and that's why. The S&P 500 will continue to go up unless the world crumbles. There are plenty of other factors at play, but this relationship remains true. Leave your money in, leave your money invested, and you're gonna reap some sort of reward at the end of the day.